I gave up managing billions to become a better investor. Episode 31, Quarter 2 Earnings Season Finale. Hello. Yes, we're at the end of the corporate earnings season. Well, of course, we're technically not, because as I speak, it's a Wednesday, and later on Wednesday, after the close of the US market, some small company called Nvidia, which you may have heard of in the last few months or so, has got its set of numbers out. But as I said before, I think I said it on the previous podcast, there's always some company somewhere just about to give numbers out. It's just where the majority tend to put their earnings season results. So anyway, in my opinion, we're at the end of the earnings season, even though I know next week, for example, there's a bunch of quite interesting companies out, Prudential, for example, which will be quite fascinating about insurance and related in Asia and other parts of the world. But that's another story, and we'll come on to that in another week or so's time. And I guess we could talk about macro matters, but I'm going to leave the BRICS meeting and Jackson Hole discussions about central bank policy related. I'm going to leave that to the next podcast in a few days' time. Let's talk about the end of the quarter 2 earnings season. It's funny, isn't it? I mentioned on a previous podcast that the Japanese market had been showing sort of 60-odd% beats, which is pretty good. Perhaps an expectation, though, or reflection really of low expectations going into those numbers. So that was interesting. I always think Europe, the pan-European markets, is always the best guide really to earnings season, because historically I found that it's a little bit more realistic. I think it's the flip side of Japan doing quite a bit better than expected is because there were low expectations. So by contrast, when I look at the States, all due respect, but a 79% beat rate kind of sort of indicates to me once again that you've sort of got some lowered expectations just before the numbers come out in order to beat them. Europe, by contrast, I think it's a better guide. It seems a bit less of the producing numbers before earnings season occurs in order to beat those lowered grades. So the 50-50 split, I think, is kind of indicative of the backdrop that we should see as investors in the world, irrespective of whether you're a macro sort of technical investor or whether you're sort of a micro kind of sort of slow philosophical, careful investing sort of person. I think it's a really patently, clearly an active market out there, which is very exciting for me, because we once again come clearly well away from the 2010s norms, getting back more towards the sort of decades that I grew up in when I learned to become an investor. I learned a lot of interesting areas around that. And you can see in previous podcasts me talking about matters I've learned over the last 30 odd years or so. And certainly the first 2/3 of that was centered on an active investing world where you had to pick carefully, mainly because there was a lot of natural volatility. Not most things were going up and related. So I'm kind of intrigued to see pan-European markets at the Stock 600 split around about a 50-50 measure. We'll see where they formally end this month and how that kind of formally goes for the quarter 2 period. But I think it's going to be either side of a 50-50 split. Where it gets interesting is when you look at what particular sectors were beating and which ones were missing. The beats strange list, actually, in a certain way. I was surprised to see financials at the top. Okay, perhaps low expectations going in there. And of course, well, we can discuss financials at length, but clearly we all observe that there have been some interesting areas of volatility and related over the last few months, even in Europe, let alone the States, of course. Next up were both sort of sides, and this is again using the Stock 600 measure of sectors. As you know, I have my own personal ones, but just use the Stock 600 split. Either side of the consumer space, what they call cyclicals and non-cyclicals, they beat by over a 50% split. Healthcare, yeah, I would understand that. And the final one was industrials, which is interesting, always an area where careful choice is important. So that was intriguing. Below 50%, so doing a little bit worse than the norm, if you like. Real estate, quelle surprise, no surprise there at all. I think we've talked enough about house prices where they are and are not likely to go over upcoming years. Also in the sort of the, in quotes, losers list, or had more companies missing than beating, energy, again, no huge surprise. Utilities, technology, kind of interesting. Of course, pan-European technology sector is a somewhat smaller mix than perhaps the Nasdaq induced S&P 500 one. And also materials. Now, materials is something I've talked about at length on podcasts over the last few weeks. Certainly interesting to see BHP Billiton numbers out earlier this week. Enjoyed looking at those, although in terms of stocks that I am even more interested in, I would say Rio Tinto would probably be a name which I spent quite a lot of time looking at a few weeks ago. And I wasn't surprised that people a bit akin to energy, or to some extent European tech, however you want to quote that, I'm not surprised there's been probably more than 50% missing there, on the basis that clearly you've got some little macro changes. Certainly the comps versus last year are harder. And when comps are harder, guess what you tend to miss? People, it's funny, isn't it? Brokers often are not that pessimistic, or find it hard to be actually notably more cautious, even when you've still got to make money, generate free cash from related, to put in a sort of a 20% worse than this time last year. It sort of psychologically feels, I think, a little bit tough for them. By contrast, 20% beat, no problem at all. And hence why I think maybe financials are in that interesting beat by more than 50% list for the pan-European sector split. Mainly because I think people have gone into the quarter probably with quite low expectations of financials. And let's face it, issues in Switzerland have kind of worked themselves through, saying that UBS got some formal numbers out next week as well. So we'll see what they say. But I think you've seen, certainly across many other European names, not so much in the UK, but more in continental Europe, I'm not surprised there have been beats versus some quite low expectations. Clearly, a year ago, you were just a few months into sad events in Ukraine and related, and consequently financials, inevitably, you put together fears of recession, fears of lack of growth, volatility, high prices, generally in investments and industrial areas struggling. No surprise that financials would get a bit pushed around in that. I think what's interesting, though, is we must take a look at the S&P 500 mix. And as I say, I've already mentioned the fact that you once again got a big proportional beat, but let's put that aside. When you look at the sectors, which sectors in the States were beating versus expectations by more than average? Let's put it that way. I wouldn't say more than 50%, because frankly, I think most sectors did by quite handsomely. But the best ones included technology. So I say the complete reverse to Europe or pan-European indications. We can debate some reasons. We talked about technology a little bit on a previous podcast, and as you know, I kind of feel that many of the prices are kind of thereabouts. I've actually been reducing my exposure to the technology sector over recent times, at least changing it. So it's certainly reflective of an active world, also a world where perhaps tech being your number one choice forever, kind of, there's a little bit of debate in that. Anyway, technology in the States, healthcare, so akin to the pan-European performance, and I would agree on that. Healthcare's intriguing to me. Actually, if you look at the performance of the sector in pure percentage terms in terms of percentage performance terms of the sector stocks year to date, it's relatively disappointing, but both sides of the Atlantic. And I think that's more of an opportunity than a threat. And I've talked in recent times about some interesting splits, some what I think now is undervalued areas. Yeah, I think it's a sector to be looking at the moment. Interestingly, a bit akin again to the pan-European sector split. Both consumer sides, both cyclical and non-cyclical areas beat quite well. So again, indicative of even though consumer spending we know is a little bit mixed and perhaps it's going to get a little bit more difficult as the rest of the year progresses. Certainly, maybe against now probably raised expectations after a pretty good quarter. Pricing power was good for many consumer stocks, and that assisted some of the beats, I think. By contrast, some of the losers, some things akin to Europe, real estate, utilities, no surprise there. By contrast, though, kind of fascinating to see financials in the States among the more relative loser areas, as I say. I think more than 50% beat expectations, but it's obviously less of a proportion than many other sectors. So again, that was a bit of a contrast to Europe, where it actually topped out the relative betas proportionately. And I think that reflects obviously some of the challenges, specific challenges that the States had, US financial sector in the earlier part of this year, not that many months ago, let's face it, when obviously more than a couple of banks ultimately were merged into some of their bigger peers. And obviously that creates uncertainty and lower valuations and related. So am I too surprised? Not particularly, that even kind of what was undoubtedly reduced expectations, the beat proportion was not as high as many other sectors. I wasn't particularly surprised by that. As we've talked about, I'd personally be a bit cautious on financial stocks, some specific plays, and again, we'll come on to the Pru numbers in the insurance space next week when they report. So that was kind of intriguing. You kind of pull all of that together. What does it sort of say? Well, at a sort of a kind of an underlying micro level, if you like, I already mentioned the fact that I think pricing power, however you want to sort of talk about it or think about it, was pretty good. It was certainly more than workable, particularly in the consumer sector, but I would also identify areas such as healthcare and industrials as having lots of ticks in the boxes. Of course, choice of companies is important, as it always is with pricing power, but I was heartened by that. I guess, despite some of the, not just the fact that people were coming into the quarter with still a few concerns about broader economic issues, and let's face it, and we haven't talked specifically about certain sort of Pan-Asian or developing market exposures, but when you kind of look there, you've seen some very similar kind of mixes. Certainly when I look at the average, let's call it Hong Kong listed stock or companies in other parts of the world, South America, Middle East, parts of Eastern Europe has its own, some own specific challenges, of course. But actually when looking at many other parts of the developing world, I'm still seeing okay range of opportunities. But I'm also seeing, of course, companies that miss, and you've got to now prospectively factor in what is going to happen in half two and 2024 and beyond. And I guess we'll come back, particularly after some BRICS meeting chat. We'll talk about a little bit about China and some of the discussions there over recent times in broader markets, as well as in the Communist Party in China themselves. So that was kind of from a micro perspective. It clearly is an active market. I can't say that, reiterate that more times than one. From a macro perspective, touched already on some of the debates and concerns. And of course, macro also touched on bond markets, an area which has been numerous times has been cited on this podcast. And it's kind of fascinating thinking about bonds and thinking about bond yields. Interestingly, today, as I speak, bond yields are a little bit lower after a pretty poor so far August, and let's face it, a pretty poor in many cases year-to-date performance. Certainly, you'd have probably had a better chance of making money in the average equity allocation than with the average bond allocation. And even if you talk about total returns and yields and related also added in, even though bond yields have gone up, you're now getting paid much more than you were a couple of years ago. You could say, well, hang on, equities have been paying me in many cases equally, if not more attractive yields for quite a while versus bonds, which, when you've got that growth potential for equities too, as we talked about before, not going to talk about again why I'm still holding, 90 whatever percent in equities and precisely 0.0% in bonds, and why, if you're under 50, you really should not be holding bonds. But hey, we can come back and talk about that at another point later in the year. I think I've done that area to death already. So an interesting backdrop, and not impossible backdrop. How is this sort of, I can talk about this macro, micro, active market thing forever as always. How has it practically changed my personal allocations? Because I guess ultimately, whilst I can talk all I like, what have I actually physically been doing? And of course, I'm not a day trader. I'm a sort of a medium term, generally that kind of either side of a year sort of time period. Some's a little bit less, sometimes quite often quite a lot more. And in some cases, many years more of a sort of a fundamental investor, really, a thoughtful global investor, more akin to what I was in my institutional investing days. Well, what have I been changing in terms of those allocations? Well, kind of interesting, isn't it? There are some areas, I mean, once again, come back to what I would call facilitation, which I know is controversial, is my own personal sector choice, but that kind of mixed sort of company profile, and that's certainly an area that I've been allocating to more. And I've mentioned names such as Mondi, for example. Looking forward to the DS Smith, as we're talking about another, what I would call important company in that broader sector. They've got some numbers out in early-ish September I'm looking forward to as well. But by contrast, when I look at retail stroke travel, it's one of my alternatives for the consumer space. As discussed, I think it was wise to actually take some profits on Whitbread because it hit one of my earlier targets. Still holds shares, but I thought that £35 plus level was the time. Some great purchasing, great participation in their money raising at £20 a couple of years back. I've taken some profits there, which has been great. But by contrast, of course, as you sell one, maybe you look for other areas. And is it still an interesting space? Consumer space is still interesting to find opportunities in, not impossible at all. The same I'd say is true about industrials. And I won't bore you here about individual names, but again, I found generally the broader industrial sector globally to be of interest at the moment, in the sense that sometimes never highly valued, at least at the moment, not highly valued, good free cash flow, good pricing power in many cases. Yes, there's macro uncertainty, but I think maybe the overly or not correctly forward priced in. So I find there's some of those areas of interest. And again, I can bore more at length on those specifics if you wish. Technology is a bit more now moving more into the middle ground. You know, I've already talked about how healthcare's been I've changed some healthcare angles there. Again, a bit like some other names, I took some profits on Novo Nordisk after their excellent recent update. And as always, it's never wrong to take a few profits. It might be a little bit early again. It's not the first time I've taken the profits on Novo Nordisk. Great company. Just when you think it's appropriate after a great run to take some profits, absolutely fine. Still have a holding, actually proportionally because of the profit, the share price gains over the year to date and last year or two period. Probably not a particularly different proportion allocation of my pension fund than, let's say, a number of years back. But I feel it's fine to take some profits and find other opportunities. And certainly, as I talked about briefly the other week, I've started slowly building some holdings in Bayer, depending on how you want to pronounce it. The German listed name with some fascinating, actually much more than just healthcare and pharmaceutical exposures. As discussed, I think when we talk about the broader minerals and related area, we then start talking about ag and agriculture. And of course, Bayer has exposure to that space too, which I thought was interesting, particularly when we come back to, and I can talk about this more again at length at another time, but my perception would be the still new, recently appointed CEO at Bayer. I still wonder whether we may see a split of the company, which I think is something which has certainly attracted me to other names historically in the past. And I make a quick mention here of Alibaba, where obviously the six-way split has been discussed for a number of months, and you're kind of moving closer to that formally occurring. And again, even though there's been obviously volatility in tech and, as I said a few minutes ago, a sector where I perceive that actually valuation is generally in certain California technology names is now more fully priced in. And as discussed, I have taken some profits for the first time in a long time. My goodness, it's many years. Actually, I'm trying to think how many years it now, but many years in Alphabet. Saying that, I did buy, as I mentioned briefly a week or so ago, I did buy some further shares again at $60 odd a level in PayPal, which I thought was an interesting further acquisition. I did it a while back, looked to work really well. Shares fell back, bought a few more shares, etc. Not a big holding, but actually, I think it's undervalued. And the same I would say is true of Alibaba, where you've got the split occurring there, which I think is an interesting backdrop. But actually, despite macro concerns about China, and I guess you would therefore say some micro issues as well with any company with a consumer tech and related sort of underlying exposure, far from impossible, and actually, in my opinion, undervalued. We shall see whether that's correct or not. But as you can feel, I've made some changes over the summer, mentioned a number of them. It's not been radical, not loads of ins and outs, but it never is. But I think certainly when I'm looking across the rest of this year and into 2024, that kind of 12-month or so kind of forward time perspective, time to make a few changes. But it's not an impossible backdrop out there. I've still got only very limited cash. I still don't own any bonds. I'll let you know when that changes for all the reasons discussed before. I'm finding much more total return opportunities in equity markets for my pension fund portfolio. We'll see over time whether that's correct or smart or whatever, of course, but it still works for me at the moment. So I guess what I'm trying to say, all good fun. Looking forward to the comments by Nvidia, not a stock I own, but a stock that I'm now following this evening as I speak. Conclusions and related from the BRICS meeting, Jackson Hole, and we'll pull all those together probably with a podcast on Saturday. But it's clearly an active world, clearly an interesting macro backdrop, clearly far from boring. So you put all of that together, and as always, investment remains intriguing, to say the least. So on that positive basis, and as you know, I'm a glass half full sort of guy in any case, thanks very much for listening, and we'll speak again soon. Next podcast on Saturday. Thanks very much, and goodbye.